Hello, my name is Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business News, and the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've traded my own money for well over 20 years now. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you learn how to take control of your finances, manage your own portfolios, and most importantly, manage your own risk. And I've traded in most markets throughout my career, from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, and currencies, and then options on all of those contracts. I want you to know that this is an educational company, and we're here so that you don't have to rely on anyone else to manage your own portfolios. I'm going to teach you the rules to implement trading strategies into your own account. Having said that, I do have a few housekeeping things to go over. This disclaimer talks about that everything that I do in these online tutorials are going to be hypothetical or simulated performance. The fact of the matter is I don't know if you've watched this 2 years down the road or even 2 days down the road. The strategies that I come up with to do these online tutorials are not necessarily going to be the right strategy 2 years down the road or even 2 days down the road. As you will learn from my rules, that I don't hold everything to expiration. I try to take advantage of certain aspects of the market, and those are going to be very time sensitive. So I can't really do that on a video tutorial where I don't know when you've watched it. This disclaimer goes on to talk about that we are an educational company and that the things that I teach you in these online tutorials are for your educational purposes only. The fact of the matter is we are here to teach you how to swim. We are not here to swim for you. So at the end of the day, the bottom line is do your own homework. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. And you're going to hear that quite a bit, especially if you watch these tutorials. Anyway, let's get on with it. Options Basics Part 7. This is Part 7 in a series of several online tutorials that I'm going to be doing, where I'm going to be going over, in the beginning, I have already covered the history and some of the basic terminology that you are going to need throughout these Options Basics tutorials. I'm getting into a little bit more of the more dynamic strategies. These are the different types of condors, which I've covered in the one previous, and we're going to be moving on to the butterflies. And the butterflies are going to seem a little bit scary. There's 4 parts to them, yes, but the fact of the matter is they have a lot of the same methodology built into them, whether it's a short call butterfly, a short put butterfly. Those two are going to be very closely related. And then the long call butterfly and the long put butterfly. Those we're going to be looking for certain situations in the market that are going to be very close. So let's move on to the call butterfly. The call butterfly is basically creating 2 call spreads where the seller of the call butterfly is expecting that volatility or the vega to expand. So when we're selling the call butterfly, we want to be in a low vega environment or low volatility environment, and we want the underlying to move rapidly either to the higher short call or the lower short call rather quickly. That way that gets the vega to expand rather quickly and we get away from our base. Now the idea of building a call butterfly, we're going to sell one in the money call, which is going to be the lower strike. We're going to buy 2 at the money calls, which are going to be the same strike price. And then we're going to sell one more out of the money call. So the idea from the previous slide is that we are going to be implementing this strategy when we're at the money, and we want this to quickly move away from that at the money call to either the lower strike or the higher strike. This will give the trader a net credit to enter the position. The max profit. The max profit is going to be the net premium received minus your commissions paid. Now, I've told you in earlier tutorials that I don't like to add in the commissions paid, but on these more dynamic or four-legged type of options, commissions paid is going to become a very real factor. So we want the underlying to be either less than or equal to the short strike, or we want it to be less than or equal to our higher short strike. The max loss on this butterfly, on the short call butterfly, is going to be the long call minus the short call minus the net premium received. And we really want this to move away from the middle strikes, because if it pins at our base, that's when we're going to receive our maximum loss. We really want this to move away from the base and to the wings. And the break even is going to be, for the upper side, the higher short call minus the net premium received, or the lower wing break even is going to be the short call plus the net premium received. And you will have to take into account your commissions paid on this as well. The short call butterfly also is going to have assignment risk, because remember, when we implement this strategy, we're immediately implementing a short call that is in the money. So you're going to have to be very cautious of taking this into expiration. And as you will learn from my webinars and my online classes, that I don't really take anything to expiration. I look for a set parameter as to where I'm going to take profits. That's going to be a percentage of the premium that I receive, and we'll go into that in a lot more detail because it's really dynamic, and I could spend one whole hour class talking about the timing of implementing and the timing of exiting any of these strategies. So really can't go into that in one of these 30-minute tutorials. But the assignment risk you're going to have to be very aware of, because if you implement this strategy where there's a dividend or something along those lines, somebody may want to assign that just to take advantage of the dividends or the special dividends. Also, if there's a restructuring or capitalization event, like a merger, takeover, or spinoff, that's immediately going to affect the price of your underlying, which is going to also affect your strike prices or how this moves. You know, it could help you out in the fact that it moves quickly to one of the other extremes, but it could also pin it right there at your strike price in order to wait out any further news. So you got to be really aware of that in all of these butterflies, for that matter, and you will see that come over again and again. Now we're going to look at a specific example here that I did, and I've kind of stuck with eBay along these lines. eBay's been trading pretty flat, so it's been and right around this 62.5 strikes, so it's made it very easy for me to come up with different types of examples. In this particular example, you can see where our break even is, where it crosses the dotted line here, and you can see our max profit and max loss. The max loss is in the bottom where it comes to a point, and the max profit is the upper band above the dotted line where it flatlines. Now keep in mind, this shows a max profit of $100, and that's because I've done a total of 2 contracts. If you look here at the bottom, our max profit really on the butterfly is this 50-cent credit, or $50. But because I broke it down just below that into the different legs, it shows it as 2 contracts. But having said this, with the lagging type of the spread underneath, I've adjusted the prices to equal the net credit. Don't ever try to leg these kind of spreads. You will only lose money on it. You will not be able to get as good of a price. 50% of the time, they say, but the 50% of the time that you leg it incorrectly, or you will not match the credit you would have been able to do with the butterfly. The reason being is the counterparty doesn't want to take the risk, and if you try and leg it, the market can move in a matter of seconds, and your prices are going to continually change on the legs. So always enter these big spreads, or any type of spread for that matter, as a spread. Don't try and leg it. It's a bush league type tactic. You will ultimately end up not making money. But here we have the construction of the short butterfly. As I said, we're going to sell one in the money call, which is the 60 strike, and then we're going to be buying two at the money calls, which is the 62.5 calls, and we are going to be selling one 65 call, which is out of the money. And our total net credit is 50 cents. Now, so we said our max profit is the $50 or the 50-cent credit, and our max loss is going to be when it pins at the 62.5 call. So if you want to figure out your max loss, you take the lower strike minus the 62.5, which is 2.5, right? If it at expiration was right at 62.5, we would be looking at a intrinsic value of $2.50 for that 60 strike. The rest of them are going to expire worthless. But that lower strike is going to have $2.50 of intrinsic value. So we're going to have to buy that strike back for $2.50 or $250. And we subtract the net credit we received, which was $50, or this 50-cent credit. Remember, anytime we're dealing with options, you multiply it by 100 because it's worth 100 contracts underneath. So if it's a 50-cent credit, it's actually a $50 credit. If it's $2.50, it's $250, if that seems to be confusing. So we subtract 250 minus the $50 credit we received. Our max loss is $200. Now keep in mind, on this chart, we have a max loss of $400 because it's doubled in the fact that I have done 2 total contracts. If you look below, we sold the 60 calls for $3.10 credit, and we bought the 62.5 calls for $1.75. Now remember, because we've done 2, we've got to double that debit, and then we sold the 65 call at 90 cents for a total credit of 50 cents. I hope that all makes sense. We did a total of 2 contracts, so therefore our max profit on the chart shows 100, and our max loss on this graph, I guess if you will, is showing 400. But that's because we've doubled our risk.